Good morning. Thank you for tuning in to another edition of Pre-Market PulseScan with yours truly, Dex the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com, home of the world famous, infamous PulseWave trading system. System. That's my own little, ghetto echo in the background. All right, so we got another day. It's Tuesday, turnaround Tuesday. First of all, what's up, everybody in the live? What up, Sling? What up, Paul? What up, John? What up, Joel? What up, peoples? Everybody pimping these markets. All right, so we start off with a very interesting overnight market. We're going to look at that right quick. Then we're going to get into some things. So right now, the Dow futures is up 110 points, trading at 24,232. Your NASDAQ 100 is up 32 and a quarter points at 93.11 and a quarter. M&E S&P 500 up 10 at 29.32 and three quarters. Your Russell is up 10 at 1325.1. And your Bitcoin futures composite index is up $20, trading at 88.15. It should be noted that the overnight low was 85.60. Yeah, ouch. Nat gas down a nickel, trading at $1.77. Crude oil still playing around with the $25 handle. It's up $1.35 a barrel, trading at $25.50 a barrel. Taking a look at your long bond, it's up 12.30 seconds, trading at 178 and 28.30 seconds. Hugging around between that 179, 178 handle. Not too much going on there. Gold is really struggling. It's fighting for its life above 1,700. We did dip below it briefly in the overnight. Went down to 16.93 and 50 cents. Right now, we're back above 17 at 1703.6, up $5.60. Looking at silver. Silver right now is up about 4 cents, trading at $15.72. And it's really trying to stay above the $15 handle, working its way up. We'll see what it can muster up, but not too much going on there. US dollar index back below par. And it is trading near the lows of the session. An overnight low is 99.78. We're at 99.79. Taking a look at the euro, it is up 55 pips this morning at 108.73. Pound sterling is up 23 pips at 123.55. Aussie is up 31 pips at 65.15. Canadian dollar struggling a little bit, down 24 pips at 139.94. Euro yen up 34 pips at 116.72. And your dollar yen is down 24 pips at 107.41. Looking at food, you got your soybeans up 1 3/4 points at 8.56 3/4. Your corn is down 1.5 at 3.17, and your wheat is down 5 1/4, trading at 5.12 even. All right, so that's your overnight markets. Not too much going on there. It's been relatively quiet, which, I mean, how long has it been since we were able to say that? Seems like every day has been some sort of fireworks in these markets. Just unbelievable situations going on. So to be quite honest, it is good to feel some sort of relief in these markets, because to tell you the truth, it's been a straight struggle. It's been a struggle, fam. All right, we've been dealing with a lot in the markets, a lot of going back and forth, a lot of rules, regs, laws being passed, the whole nine. It's like, the world is just going crazy. So that's been something we have to have been contending with as of late. And we soldiers over here, so we deal with it. We take things as they come, and we deal with them. We don't run away. We don't cower. We're not afraid to talk about things that make other people uncomfortable. All right. Oh, okay. I'm getting feedback. I'm getting feedback on the pimperage, the forex pimperage. All right. So Mick says that the new forex is working. It's very nice so far. All right. All right. That's what's up. That's what's up. All right. So the forex report, the little testing test we're doing. All right. So that's good for the first day. Technically, yesterday was the first day, or I should say, today's session is the first live session for it. I wanted to start Monday, but I just wasn't ready. I couldn't get it up and running in time, but I got it running now. So yeah, that's good. That's good feedback. Anyone else having some success with the new forex, whether you're using the action pack forex or you're using the full forex report? Let me know. Oh, it's working in both ways. Oh, I like that. That's really powerful. Okay, that's what's up. That's what's up. Yeah, man. I spent a lot of time working on it, and then it finally hit me too. I was like, you know what? I need to go back to my roots. I need to go back to doing what I used to do, and what I used to do. And just to let you in on a little secret, what I do, markets that I know I'm going to be actively trading in and out of the most. When I say markets, I'm talking about the futures and the forex specifically. Um, I do some mathematic gymnastics, and I do my report by hand. Yeah, I like to get in there and roll my sleeves up and do some stuff with the numbers. So for the futures markets that I am active in, such as the stock index futures and crude oil, gold, and silver, those I do by hand, and I do some gymnastics so that my stuff is totally different than what other people will get from the exchange. Likewise, I do the same thing for the forex. Doesn't matter what broker I'm trading with. I use the actual broker's data. I don't use anyone else's data. I use the broker's data. And the reason for that is because not all brokers necessarily work on the same platform, and not all futures contracts um, will necessarily roll over at the same time either. Most brokers do roll, like, the last Friday or the third Friday of the month before expiration, but I don't rely on that. I do my own thing. And when you get your data from your repositories, they don't. It's just an old school thing. If you don't trade futures, you wouldn't know it. You wouldn't even realize it. All right, so okay, my man Mick says going long and short throughout the day, catching tops and bottoms and reversals. Wow, that is sick. I love it. I love it. That's what I'm talking about. Man, if you knew how much blood, sweat, and tears I put into these reports, these are the most bumping reports in the world. The most kicking, the deafest, the dopest, the flyest reports on the planet. And I've been working 20 plus years to get them to be that way. Most people try to do things based off statistics. Well, 89% of the time the market will do this or that, and so you can take advantage of this anomaly. No, I don't do that. I don't care about your statistics. I care about day-to-day price action. If it's a market that trades like 24, 23 hours a day, then I care about what it does in the night, and I care about what it does in the day. So I look at those intraday price inflection points as well as overnight price inflection points. And then I add the predictive programming, and voila, you got yourself a masterpiece. That's how we do, fam. That's how I roll up in there. All right. As long as it's working, as long as I can put the money in your hand, that's what this is for. This is what it's for. It's for me to put the money in your hand. Because again, like I always tell you, I'm only as successful as you guys. So if you guys are in it and you're making money, that is what it's about. All right. So that's why we exist, to put money in your hand. All right. I see you saying, Tanner, man. Look, let me put you like this, fam. Don't get bogged down with all the details. Just follow the system, right? Just that's it. Just place your long and your short orders, put your stops in, and the market will take care of the rest. You don't have to understand oh, it's in the black box. Just like I don't understand everything that makes up my car's engine. All right. I can barely even change the oil. Okay. So that's why they have shops. All right. I have a trusted mechanic I can take my car to, and they will work on it for me. All right. They can change my oil. They can rotate my tires. You know what I'm saying? They can do maintenance on it. Whatever it needs, I can take it to a professional and let them do it. I don't need to understand all the computer and electronics up in the joint. I just need to know when I turn the key and when I turn that ignition, is my car gonna start? And I need to know that it's not gonna leave me stranded on the side of the road. That's all I care about. Everything else, I don't need to. I don't need to know. I don't need to know all the parts. I don't need to know the schematics. I don't need to know my engine nomenclature. Engine nomenclature. I just need to know how to drive the vehicle and keep from crashing and breaking down. That's it. Everything else, I trust. It is entrusted to the mechanic. So with that being said, man, don't get bogged down in the details. Just place some orders, man. Oh, okay, yeah, all right, yeah, all right. That's a good question. Okay, so for those that don't know, what I'm doing, I'm testing something. So those that get the forex reports, whether you get the full forex report or you get the augmented one through the action pack, what I've done is you're gonna see a few pairs, and in last night's video, I actually showed you what they were, but I'll just go ahead and tell you again right now. So basically, on the forex report, you're gonna see my euro, my British pound, my Aussie, my Canadian dollar, my euro yen, my dollar yen, and my Kiwi. All right, so you're gonna see those 7 on the report twice. The one that has the word forex in front of the symbol, those are mine. And the reason I'm doing this, I'm doing what is called a forward walking test. I think I have found out something in the algorithm, and I am testing it to see if I am correct. The only way I will know if I'm correct is when you guys are doing your thing like you do every day, is your feedback. You can let me know, yo, this is smooth. I like this. You know what I'm saying? That's all it is. I just want to know which which methodology is more on point. The old way or the new way that I'm doing. I think the new way is going to be superior because I'm literally using, O&A's data. I'm not using the repository from the exchange. I'm using O&A's data, and then I'm doing some mathematical gymnastics with it to see if I have nailed their platform. If I've nailed the platform, you will see it in the results because you'll be trading it and you'll be like, whoa, I am pulling more money down than I used to. Something is scary here. And the answer should be, yeah, it is scary because we pimping these markets, you know? Likewise, as a matter of fact, I should have thought about this yesterday. I'll do it tonight. On the futures report, you should also see mine. My stuff always has for my forex stuff, it'll say forex in the italics before the symbol. For the futures, it says futures in the italics before the symbol. Those are mine. Those are mine that I've done by hand, doing some old school stuff with them. And the end result should be this. My stuff with the italics in front of the symbols should be more accurate than the ones I'm getting from the repositories. It's a data thing. That's all I'm saying. It's a data thing. So with futures and forex, the things that I like to trade, I do a little something special with them. All right, and one of the reasons why you've been winning also so good on the crypto side is because the cryptos I'm doing like that too for you guys. You never noticed it or never known. All you know is you've been killing it in the crypto market. Well, the reason for that is because I'm using the same technique. I do it for the cryptos, I do it for the futures that I trade, and the forex that I trade. So that's it. So if you were to add it all up, I would say you're looking at about maybe 30, 40 symbols max that I'm doing by hand and doing my little mathematics with. All right. So all I can say is you will reap the rewards. And I have to do it that way. There are many reasons for that, but the main reason is because um, it's just what I do. I rob banks for a living. All right. And the only way to do that is to use their data. I use their data against them. All right. Call it trading jujitsu. You're using the enemy's strengths against them. Moving on. All right, let's get into some stuff. All right, so just when I thought it was over and we could start talking about charts exclusively again, they won't let us, because all the stuff outside of the market is affecting the market. And this explains why we've been kind of consolidating right here too. You can tell the market is waiting for the next shoe to drop. Oh, and it's about to. Okay, you said the euro dollar triggered short, then reversed and stopped out. Okay, so when it reversed, when the short stopped out, did you get long? And is the long panning out? That's what I need to know. That's what I need to know. Got to know that, because you have to follow the report. The report says you got to do a stop and reverse. I need to know that. I need to know that the stop and reverse work for you, because that's what it's designed to do. So if there's not a lot of money on the table on the short side, you'll get stopped out. You're supposed to, and then you reverse and you get long. That means the money's going to be on the long side of the market today. Yeah, that's like a backstop I built into the algorithm. Likewise, if you went long and that got stopped out, that's cool. Now you're short, so you should make your money on the short side of the market that day. It's a price inflection point thing. Difficult to explain, but you just have to get in there and bang it out. So if that long panned out, let me know. Let me know, because that what you're telling me right now is that the system is working the way it's supposed to, because that's what it's designed to do. It's designed to put you in the right side of the market. If the market decides it's going to change its mind midstream, then you're supposed to be up in there like that. Because I'm looking at the market right now, and it's looking like that long, sure enough, did take care of itself. So and I do see where the market did pull back slightly, enough to trigger the short. So if you are long, if you got long when you got stopped out, you should be golden right now. Yeah, that's correct. Yeah, you gotta you got to yeah, don't worry about the momentum trigger. Don't worry about that. We're talking about the actual entry triggers for long and short. Don't worry about the momentum trigger, because that means you're not following it. That means you're doing it backwards. And like Mick just said up top there, remember the adjusting the pips video that Frank and I did? That's very important. You got to do that when you're using the O&A platform. You got to make that adjustment, because if not, then the spread will get you in, and you don't want the spread to get you in. You want price to get you in. Does that make sense? So if you need to go over that again, holler at us, when we're off the air in the trading room, and then we'll walk you through it. Not a problem. All right. But right now, you should technically be long in the market, and you should have already made what you made back your money if you got triggered short today in that euro, or at least be on your way close to it. Does that make sense? All right. Yeah. So execution is key too. Execution can be tricky at times as well, and it's all about putting the orders in. By putting the orders in, what will happen the majority of the time too, it helps to correct human error also. Because what happens is, if you go ahead and you put your 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 tickets in like you're supposed to ahead of the market, then what will end up happening is you'll be in a situation where Even if you forgot or you made a mistake or you did something like that, what's going to end up happening is it's going to self-correct for you because you'll be like, oh man, okay, my short got stopped out, oh, but I'm long in the market now. Okay, I see. That's what I'm talking about. And that's all we striving for in that one. So there you go. All right, let me see here. Give me just a second. I need to check something real quick. Okay, nope, that's the wrong one. Let me go back. Okay, there it is. There it is. I see now. All right, so let's see. Looking at it again, 108. Okay. All right. So there's the Aussie. Okay. All right. Okay, so all right. Oh, what am I doing? Bear with me just a second. Okay. All right, now we got this straight. Okay, so yep, you got involved today. Yep, I see it. Okay, 106. All right. Okay. All right, I see. All right, I think I know what may have happened on that one. See, this is why feedback is important, fam. I can't stress it enough. Feedback is so important. I got to know what's going on. Okay. All right, Frank, let me ask you, because I don't know. Do they, is that other report, is the, what do you call it? Is the loaded report available off the dashboard? Because that's important to know if you're listening, my brother. Let me know. Hit me back. All right, let's move on real quickie. All right, so this is what we got going on right now. All right, so we got, okay. The Georgia Department of Public Health has announced that the United States Centers for Disease Control and Prevention, and county health boards are together sending teams of government agents to randomly selected homes in 2 Georgia counties. These teams of government agents are charged with asking questions, including about household members' health, and extracting blood from all the people living in the homes. The reason given for the home visit is coronavirus. J. Scott Truby writes at the Atlanta Journal-Constitution that the government agencies are seeking the blood to test for antibodies to the novel coronavirus to pinpoint who might have had coronavirus 19 and estimate how widely the virus has traveled. I cannot believe they're sending government agents from door to door collecting your blood. Is anyone really hearing that? People who lived at the 420 randomly selected homes are free, Truby writes, to refuse the questioning and blood drawing by the government inquisition and phlebotomy teams that show up at their front doors. But in reality, people often find it hard to muster the courage to say no to the government agents who accost them in person, asking them to comply. People are intimidated. They think that even if they say no, the requested action will still be taken anyway, plus they will suffer additional consequences for resisting. That aids police efforts both to get people to say incriminating things and to obtain permission to search people and property, even from people who know evidence of a crime is likely to be found. A CNN report by Dakin Andone shows that the government teams knocking on doors are employing some of the look of cops in their effort to obtain maximum voluntary compliance. Uniforms, government badges, official letters are all part of the process, just like when cops show up for a home search holding a warrant. Health workers conducting the survey have CDC vests and badges, the news release said, and are carrying a letter from the CDC and the Georgia Department of Public Health. Plus, like you need more, the goal of the people running the program is that the maximum number of people comply. Whoa! A quote from the Georgia Department of Public Health Commissioner Kathleen Toomey puts it this way: "We encourage everyone who was visited by the team to participate in this very important survey that can help public health officials assess how widespread COVID-19 is in certain areas." In a Tuesday Washington Times editorial, Cheryl Chumley discusses in detail the disturbing nature of the knock and draw blood program. And she points out that a government that really was seeking volunteers instead of seeking to pressure people to comply would act differently. Government officials could just as easily put out a notification in the mailbox or online or via social media or over the television and radio airwaves, asking for citizens, volunteers to come down to the local health department clinics and then donate blood for the purposes of tracking COVID-19, for the purposes of helping the investigation into the spread of the virus. Seeking volunteers through those methods puts the control in the hands of the citizens. Those ways make clear the blood offerings are completely voluntary. This looks like a program that could expand countrywide. In fact, it fits in well with moving into a forced vaccination and digital certificate next phase of the coronavirus crackdown. Doing a test run in Georgia makes sense because the CDC headquarters is there. But that's not the only thing there. You got the Georgia Guidestones in Georgia. Not only that, but that's also the first place of the coffin liners that were found. Left that part out, didn't you? So what's your plan for when government agencies come for your family's blood? The government inquisition and phlebotomy teams are acting much like cops, seeking to pressure people into providing private information and even their blood. A general sound course of action with cops is not to talk to them and not to give them permission to do anything. The same course of action can be employed when confronted by these new door-to-door bloodsuckers. I hope you guys were paying attention to that one. That is the most obnoxious report I think I have heard throughout this entire ordeal. But wait, hold on. Isn't that what you expect them to do, though? Think about it. Problem, reaction, solution. They're going door to door because they want to see how effective their kill program has been, or enough people kicking the bucket. All right, the Federal Reserve and its ongoing destruction of the bottom 90%. All right, I told you we're going to break these markets down. All right, here we go. The Federal Reserve seemingly is an ongoing mission to destroy the bottom 90%. The one lesson that we have clearly learned since the 2008 Great Financial Crisis is that monetary and fiscal policy interventions do not lead to increased levels of economic wealth or prosperity. What these programs have done is act as a wealth transfer system from the bottom 90% to the top 10%. While we will address the statistical data, there is also the anecdotal evidence which supports this thesis. Since 2008, there have been rising calls for socialistic policies such as universal basic incomes, increased social welfare, and even a two-time candidate for president who was a self-admitted socialist. Such things would not occur if, quote unquote, prosperity was flourishing within the economy. The disparity between the Fed's interventions, the stock market, and the real economy has become abundantly clear. For 90% of Americans, there has not been nor will there be any economic recovery. Any economic recovery. No, nada, zilch, zero, Nathan. 90% of Americans will not be bouncing back from this. That means no economic recovery. None, 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 yeah. Stocks are not the economy. Companies derive their revenue from the consumption of goods, products, and services they produce. There it is logical stock price appreciation over the long term has roughly equated to economic growth. However, that relationship has become unhinged since the financial crisis due to the Fed's interventions and suppressed interest rates. Suppressed interest rate, underline suppressed interest rates. Again, not allowing the market to have organic price discovery, or in this situation with bonds, organic rate discovery. From January the 1st, 2009 through the end of March, the stock market has risen by an astounding 159%, or roughly 14% annualized. With such a large gain in the financial markets, there should be a commensurate growth rate in the economy, right? After three massive Federal Reserve-driven quantitative easing programs, a maturity extension program, bailouts of TARP, TGLP, TGLF, etc., HAMP, HARP, direct bailouts of Bear Stearns, AIG, GM, bank supports, etc., all of which totaled more than $33 trillion. Cumulative real economic growth was just 5.48%. Remember what I said to you guys back in 2013? I said, unfortunately, the higher the Dow goes, the poorer the economy is going to get, the poorer the people are going to get. Remember I said that to you? While monetary interventions are supposed to be supporting economic growth through increases in consumer confidence, the outcome has been quite different. Low to zero interest rates have incentivized non-productive debt and exacerbated the wealth gap. The massive increases in debt has actually harmed growth by diverting consumptive spending to debt service. The rise in debt, which is the last decade, was used primarily to fill the gap between incomes and the cost of living, has contributed to the retardation of economic growth. If wages don't rise at a pace fast enough to offset the cost of maintaining the standard of living, individuals are forced to turn to credit to fill the gap. The lack of savings was a recent topic of discussion by the Wall Street Journal. Roughly half of U.S. households have no emergency savings, according to a Federal Reserve survey released last year. Those that do may not have enough. Almost 60% said they couldn't tap into rainy day funds, borrow from family or friends, or sell something to cover 3 months of living expenses. That is shocking and sad. There are two reasons for the lack of savings. First, the incomes for all but the highest income Americans have been stagnant or falling for decades. Not months, not weeks, not years, but decades. For those that are not clear on what a decade is 10 years. There are 10 years to a decade. There are 10 decades to a century. Median household income in 2018 was only about 3% higher than in 2000 after adjusting for inflation, according to the census. For the poorest 20%, incomes had declined 2%, according to the Wall Street Journal. Yes, lack of wage growth is a problem, but as stated above, it is also a problem of the debt. The second reason has to do with the continuing effect of the debt households accumulated before the 2007 and '09 recession. A new paper by Antif Mian of Princeton University, Ludwig Straub of Harvard University, and Amir Sufi of the University of Chicago found that rising income inequality over the past few decades created the conditions that fed the rise in debt held by lower income households in the early 2000s. Every 3 years, the Federal Reserve releases a survey of consumer finances that is a stockpile of data on everything from household net worth to incomes. The last survey was completed in 2016. However, that study will be updated in October 2020. It will confirm little has changed over the last 3 years for those in the bottom 90%. The full Federal Reserve report can be found if you go to their website. All right. Let's see here. But I wanted to point to two charts specifically which confirm the Fed's policies have exacerbated the wealth gap. As I stated previously, the top 10% of asset holders greatly distorts the view of the economy as a whole. For the bottom 90%, there hasn't been much improvement. This is also why there are record levels of individuals 65 and over still in the workforce. It's not that they don't want to retire, they simply cannot afford to retire. Ever. They must work until they drop dead. Most of them probably will drop dead on the job. Since the bulk of the population either does not or only marginally participates in the financial markets, the boost has remained concentrated in the upper 10%. The Federal Reserve study breaks the data down in several ways, but the story remains the same. See, guys, this is why I've been trying to get the bottom 90% involved in the markets. Because the only way the top 1% and top 10% are eating is from the markets. All right. That's how they've been eating because the Fed has been backstopping the top 10% and giving a darn about the bottom 90%. But if the bottom 90% would have participated in the markets, for the most part, they wouldn't be a bottom 90%. And we would have already had a return to the middle class. Right now, there is no middle class. It's just those that have and those that have not. Can you imagine if more people came and learned how to trade the markets? Can you imagine what the world would look like? What the United States looked like if people finally opened their eyes and came on over here to PulseWave trading and start getting money in their hands every day, not having to rely on the government? I wonder what would they do then out of desperation? What would they do? How would they be able to bring forth their new world order then? If you got dude at McDonald's and Walmart making six figures in the market but still working their jobs for whatever reason, what would happen then? You see what I'm saying? What would they do? See, you got to start thinking like they think in order to beat them at their own game. They don't want you guys participating in their markets. That's why they put all these rules up. That's why they added the pattern day trade rules so you couldn't day trade the stocks anymore. All right. They did that to you on purpose. They knew who that was going to hurt. All right. It hurt the bottom 90% people. All right. It hurt them. It didn't hurt the big boys. They already can afford that. It doesn't apply to them. You see what I'm saying? Isn't that messed up? They knew that most people didn't have that and would never have it. So that would keep them shut out of the day trading aspect of the market, which is so messed up. While the Federal Reserve had hoped inflating asset prices would boost consumer confidence, consumption, and ultimately economic growth, it didn't occur. Instead, falling incomes and rising costs of living impaired the ability for 90% of families to save and invest. Again, the benefit of the Federal Reserve's interventions was clearly concentrated in the top 10%. Of course, that's who all they cared about. Okay. You said since over 90% of retail traders lose money, where are they going to get the money to trade? Well, see, that's what I said, Thunderbird. That's what I just finished saying. I said, can you imagine if people wisened up and came over here to PulseWave trading? Are you following me now? Think about what would be happening. We would be reversing and flipping the script. Instead of the bottom 90% of people being the losers, it would be them losing. Things start to change when they start losing money. See what I'm saying? Wouldn't it be great to start taking their money? That's why the pulse waves exist, fam. Just for that reason, so that the little guy can start taking the big guy's money for a change. Flip that script. Instead of 90% of retail traders losing, it'll be 90% of the 10% losing. And the bottom 90% is taking their money. Now, that's what I call a wealth transfer. That's a real wealth transfer right there for you. Boom, bam, boom, shakalaka. As noted, the Fed will update their study of consumer finances this year, but the Wall Street Journal confirms not much will likely change. As of December 2019, before the shutdowns, households in the bottom 20% of incomes had seen their financial assets, such as money in the bank, stock and bond investments, or retirement funds, fall by 34% since the end of the 2007-09 recession, according to Fed data adjusted for inflation. Those in the middle of the income distribution have seen just 4% growth. So once again, now this is another part that they don't talk about. They say that, 90% of all retail traders, lose the majority of the time, but they don't like to talk about the bottom 20% of incomes from the the top 10%, how a lot of them have been losing money in their bank, in their CDs, in their stock and bond investments, retirement funds, because a lot of them, they got 401ks and all that other stuff, and that stuff has been blowing up also. So what do you do? See what I'm saying? This isn't surprising. A recent research report by BCA confirms one of the causes of the rising wealth gap in the U.S. The top 10% of income earners owns 88% of the stock market, while the bottom 90% owns just 12%. See what I'm saying? Because most of them, they have 401ks that they're taking advantage of, and in doing so, it puts them in that higher bracket. But people in the lower brackets, they normally don't put money into their 401k or anything like that, right? And they don't have brokerage accounts on the side either. So they don't get to participate. The lack of economic improvement is clearly evident across all data points. However, it is the very policies of the Federal Reserve which have fostered the burgeoning wealth gap. The ongoing interventions by the Federal Reserve propelled asset prices higher, but left the majority of American families behind. It's like the new normal. The structural transformation over the last decade has permanently changed the financial underpinnings of the economy as a whole. This would suggest The current state of slow economic growth is the new normal, and interest rates will indefinitely be stuck at the zero rate. Such will be marked by continued volatile equity market returns and a stagflationary environment as wages remain suppressed while cost of living rise. The end game of 3 decades of excess is upon us, and we can't deny the weight of the debt imbalances currently in play. The medicine the Federal Reserve is prescribing is a treatment for the common cold, in this case, a normal business cycle recession. The outcome of those policies, while unintended, are destroying the bottom 90% of the population who suffer from a debt cancer. Trying to solve a debt problem with more debt is akin to giving a patient aspirin for the pain. While such a prescription may temporarily mask the pain, it is not a cure. If it was, then a rising percentage of Americans would not be supporting the idea of socialism. All right? That's where we are. All right? Why is the majority of Americans pushing for socialism? Doesn't make any sense. Only if you look at it in its truth, in its pure form, will it make sense. All right, here's something that we really haven't dealt with. All right, a little bit out of my purview, but hey, we're gonna go there nonetheless. Let's talk about this Bitcoin halving. All right, let's talk about that right quickie. What do you think? Let's do it. Why not? Let's deal with it. We deal with uncomfortable things here, and I deal with things that are outside of my expertise as well. Why not? All right, we're not scared of nothing here. Here's a nice little chart of the Bitcoin halving on May the 12th, which is 2:36:40 Utah time. I think that is, whatever. Anyway, what is Bitcoin halving? All right, roughly every 4 years, the Bitcoin mining reward is divided by 2, or as we call it, the halving. Satoshi Nakamoto, the creator of Bitcoin, I would put that in quotes, wanted a predictable system which inspires scarcity and fights inflation. The halving makes this possible. So you see the 2020 chart of Bitcoin halving, social mentions on social media. This gives you the social volume, social contributors, social engagement, shared links, top halving influencers, people talking about it. Average halving price prediction 9,937.27. They are way off. Currently, the market is at 87.95-ish. As the crypto's Tim Copeland details, at 7 p.m. UTC, 3 p.m. Eastern Standard Time today, the new supply of Bitcoin will drop by 50%, meaning there are few Satoshis being created each day. How will the digital gold narrative hold up after the Bitcoin halving? All right. When you start halving something, there's a lot of pressure on this year's halving. Bitcoin proponents have spun 2 narratives around it. The event will lead to a boom in prices, or Bitcoin will become more like gold in its scarcity and stability. Below, we explore the ideas behind both and what happens if neither comes true. Time for a Bitcoin bull run. After the halving, many Bitcoiners are hoping to see the price of Bitcoin go on a new bull run, break new highs, and hit ambitious targets like 288,000 by 2024, 250,000 this year, or even $1 million in the near future. But what are these predictions based on, and are they likely? Dun, dun, dun. All right, here we go. Part of it is looking at historical data. When you look at the past 2 halvings, they both precede bull runs. Take 2016, just a year later, Bitcoin hit 20,000 and attracted global media coverage. The other part is the stock to flow ratio. That is the difference between the amount of Bitcoin being produced and their amount in circulation. If demand stays steady, and the new supply of coins shrinks, then in theory, this should put upward pressure on the price. But there are challenges. There are signs that this latest activity with Bitcoin's price rebounding from 4,500 to 10,000 before reversing to 8,600 is not being led by a new surge of interest from retail buyers. While the number of people signing up to exchanges is growing, they are nowhere near the surges seen in late 2017. And considering that 2017's bull run was largely led by retail investors, this could be a worrying sign. All right. Larry Cermak. Some of you don't seem to understand, so let me help. This is retail FOMO. And he shows a chart. And he says, this here isn't below it. All right, let's see here. There are also difficulties on a technical level too. The Bitcoin halving will cut the revenue for Bitcoin miners in half. This will largely eliminate retail miners. Whoa. Putting mining solely in the hands of large mining farms with the latest mining rigs. But if miners drop off the network, the security of the network will get weaker unless the price doubles to compensate, which it isn't guaranteed at all. At the same time, fees are shooting up. A large flurry of traders and buyers has pushed up the number of Bitcoin transactions, causing fees to rise in response. A side effect of the halving, which will reduce income from miners, might be an additional rise in fees as miners need additional income to support their mining operations. If it happens, it could make the network even more expensive and slower to use. But the jury's out on whether that will happen. Dun, dun, dun. Bitcoin as digital gold. In all, there's a lot of bullish sentiment, but little more than hope backing it up. A big bull run will vindicate the bullish, but only if it actually materializes. Bitcoiners tend to refer to Bitcoin as digital gold, not in so far as a physical representation, but to do with what gold represents. It is scarce, valuable, and its value tends to grow over time. This is likened to Bitcoin, which has grown in value since it was built, although there have been big differences with Bitcoin's errant volatility, making this a difficult comparison. All right. But similar to gold, the supply of new Bitcoin is scarce, and it will get scarcer over time. The halving is essential to this. It's the point when the supply gets reduced, albeit artificially. So while the narrative applies generally to Bitcoin, it's at these rare moments when it has greater significance. The important part is the idea that this increased scarcity will result in an increase in value over time, assuming constant or growing demand. We have already touched on the stock to flow model earlier. If the Bitcoin halving leads to a bull run, it would reaffirm the digital gold narrative. But if this doesn't happen and the price continues to shrink, it's still down 50% since December 2017. Such as falling back down to 4,500, it would be even harder to maintain this connection. How can something drop by 50% or even 75% and call itself a store of value? The Bitcoin halving celebration is bigger than ever this year, with live streams and parties set up to cover it, and far more people involved than the last one. There is huge expectation around this event, with many hoping it's the launch pad, the currency needed to become a true global asset. But if the price doesn't deliver, and Bitcoin has a habit of not neatly following convention, hyperbole is the least of their worries. Dun, dun, dun. So, what say you? my crypto people? What say you on that? Do you agree or do you disagree with said article? I thought it was very well put together. I thought it was pretty dope. But, like the author was saying, it all comes down to price at the end of the day. And if the price is not reflecting the sentiment, well, then Houston, we have a problem. So since we went there, how would you like to go somewhere else with me? I'll take you on another field trip. Is everybody game for the field trip? You want to go deeper down the rabbit hole? We talked about Bitcoin. Then that means we would be remiss if we failed to mention gold in the same breath. So let's roll up our sleeves and go to work. All right, here we go. Like Kumo D said in one of his dopest songs ever, I go to work. Remember back then when him and LL was battling? He said, I go to work. All right. Bankers continue to lose their war against gold and silver. Dun, dun, dun. To begin, I want to state that there are those of you that read the article Bankers are hemorrhaging physical silver to start April. I posted an important correction to some of the data shortly after, as I discovered a mapping error from some of the CME reported data to my Excel spreadsheets regarding the stops and issues report on the COMEX traded 5,000 ounce silver futures contract. If you republish this article on your website, as long as you abided by our republishing rights for our original copyrighted content, then none of the data that contained the errors should have been republished on your website. You also may subscribe to my RSS feed here to be immediately notified of when all new articles are published on the site, blah, blah, blah. Regarding bullion bank house and client accounts, COMEX bullion banks cumulatively stood to possibly lose about 1.2 million ag ounces of physical silver from their their inventory due to the net action of 5,000 ounce silver futures contracts that stood for delivery during the start of April. However, due to the mapping error mentioned above, the data for the past 4 rolling months originally posted was incorrect regarding net gains and losses for warehoused physical silver stored on behalf of clients and house accounts. Bullion bankers still had a cumulative net positive increase in physical silver supply from December of 2019 to April the 9th of 2020 of 3.29 million ag ounces, despite the 1.2 million ag ounces that were marked for delivery during the first 9 days of April, an event that also marked a substantial reversal in the 4-month rolling trend at the time. This month, the hemorrhaging of silver has continued. Given the data from the 2019 to May 6, 2020, there has been a further contraction of the net physical silver supply in the bullion banks' combined client and house warehouse inventories by another 3 million ounces from 3.29 million ag ounces to just 250,000 ag ounces. I'm sorry, 205,000. If this pace continues, the next month should move the net gain loss of physical silver supply for the past 5 rolling months into net loss territory. Consequently, regarding the numerous videos I have seen spring up on YouTube with titles like I'm not buying physical silver and silver at these prices because they're too high, meaning prices of less than $1,800 or $21.60 respectively for 1 ounce Canadian gold and silver maple leaf coins, there are people and institutions standing for delivery for millions of ounces of physical silver that apparently disagree with these sentiments. Of course, a built-in advantage exists for those standing for delivery of physical silver with the huge arbitrage opportunities of paying spot prices for the silver and then being able to resell it at much higher prices in the physical market at the current time. Even so, a significant uptick in the number of silver futures contracts that are being requested for physical settlement indicates a belief in continued rising prices. Well, right now the futures contract is asleep, so I have to take issue with that one. With gold regarding the 5-month rolling trend of issues and stops for the 100-ounce gold futures contract, the bullion banks have lost more than a net cumulative amount of 2 million ag ounces. Okay, first of all, the 100-ounce futures contracts are non-deliverable. So that's a little misleading, sir. I don't know what kind of point you're getting at there. Keep in mind, folks, the exchanges aren't stupid though. They have created non-deliverable futures contracts, which means they are settled in cash. So storage, warehouse facilities, etc. does not apply. Okay, the writer says, as I've stressed for well over 15 years now, people should stop watching all mass media financial news when it comes to gold and silver prices, as their persistent instance of only quoting fake spot prices and never real physical prices is only going to distance you from reality. Those of you that recall my old businesses and where clients of mine know that I was the only company in the world back then, as far as I know, that believed in the purchasing power preservation properties of gold so much that my services were based upon a constant weight of real physical gold that remained unchanged for more than a decade. Nah, you were not the only ones. Matter of fact, you got to give props to the triple OG that passed away a few years ago. What was his name, y'all? Y'all know what I'm talking about. What's the dude? The elderly gentleman had a really famous podcast. He was speaking everywhere. All the big networks had him speaking on their channel. I can't remember his name. You guys know him. He's the gold guru. He used to work in the gold trading pits and all that stuff. Y'all know his name. I can't think of it. Bob Chapman. There you go. Bob Chapman. Boom. All right, Bob Chapman. Nah, you gotta give Bob Chapman his credit on that one. Unless you're saying you're older than him, author, which I kind of get the sense that you're not. You gotta give Bob Chapman his props. Bob Chapman had been doing it for like 40, 50 years. You know what I'm saying? So nah. Nope, Bob Chapman. I remember now. He was the gold guru man. He had been talking about gold forever. That was his thing. Mark Faber and them, and no, I ain't talking about that. Nope, Bob Chapman. You guys know Bob Chapman. Come on, you remember Bob Chapman. All right. Consequently, in the interest of buying gold and silver, I only track real physical prices for gold and silver versus tracking the paper prices, because absurd, unrealistic paper prices are completely irrelevant. First of all, the paper price is not unrealistic and not absurd, because your spot and your futures prices go hand in hand. You're not going to, how are you going to price gold and silver? How are you going to price any physical commodity for that nature without a spot and futures market? How are you going to really do that? How is price discovery really going to be there? Plus, futures are always going to be more expensive because it has to be added storage costs and interest. So because of that, I don't know where the author is getting at on this one. Jim Kaminsky, yeah, he's a commodities broker out of Chicago. Thanks for bringing his name up. I was trying to think of his name for the longest time. I subscribed to him under my old channel. I don't know if he's still doing YouTube videos. I'm gonna look that up right quick because I need to go back and I need to yeah, MF. Oh, he was with MF Global. That's right. That's right. That's right. What is he doing now? I gotta find out what my man is up to. I have not. I couldn't remember his name, but I was one of the first people to subscribe to my brother back in the day when he first started doing YouTube videos. And I remember he was giving away the heat miser things. He was giving that away. Y'all remember the heat miser? If you predicted, I think you had to guess what the price was or something like that. Yeah, that was my boy, man. Okay, so yeah, this is all I'm saying is old stuff. Does anybody know? Is he still on social media? Where did he go? Does anybody know? If so, let me know. Cause I like him, man. He's a good dude, man. But I don't see nothing on here for him. All I see is old stuff. So I don't know if he left the business, went to another firm. Wait a minute. Did something happen to my man? He died. Are you serious? When did he pass away, man? Jim Kaminsky? Okay, then that explains why I see RIP Jim Kaminsky on this one video that was 4 years ago. Oh my goodness. 4 years ago? Oh man. Man. That sucks. He's a young he wasn't no old man. That's okay. You said four, yeah. So I know it's been at least 4 years at least. So that's 2016. Good grief. So that means he passed away not too long after Charlie did. Then, goodness, man. All right, that just ruined my day. Goodness, I didn't even get a chance to holler at the brother, man. Goodness, that sucks. So I need a minute, man. I can't believe that, man. He gone for real? Man, that sucks, man. As far as I'm concerned, he was the only bright spot at MF Global. Period. Hands down. He was what? He was diagnosed with cancer and committed suicide? Are you serious? Stop playing with me, man. Come on, dude. Please don't tell me that. Don't tell me that. Are you serious? Are you playing with me right now? Diagnosed with cancer and committed suicide? Oh man. That sucks. Didn't he have a family? Didn't he have wife and children and stuff? Oh man, that just messed me up, man. He was a real one, man. He was a real dude. One of the few people on social media that A, knew what they were talking about, and B, worked in the industry. He was a commodities futures broker, man. He had his Series 3 like me. He was out there doing the darn thing. All right? Man, it hurts when one of the brethren passed like that. And he wasn't even an old man. His family was devastated, I bet. Oh, man, I wish I could have talked to him, man. Good grief. Good grief. Oh, man. I'm sure that MF Global thing must have really tore him up, man, because he was there. You know, he was there. Now, I didn't work for MF Global, but they were our clearing firm, though. So, Man Financial was our clearing firm. Matter of fact, I met a real cool dude that worked in their main headquarters or whatever. Cool dude, man. Matter of fact, I don't know what he's doing now. He always said if I ever came up to Chicago, he would walk me onto the trading floor, to the CME, to the S&P pit, or the Euro dollar pit. Man, I never got a chance to go either, man. All right, that's devastating, man. His neighbor filmed all his shows. That's what's up, man. Goodness, man. Why all the good people gotta just roll out, but all the buzzards are still kicking? I tell you, man, that's messed up, man. All right, Jim Kaminsky, R.I.P. Jim Kaminsky. He was a real dude. He was a really good broker, and I never got a chance to meet him face to face, but you know, We were doing shows, doing the rounds back then. I think he may have been on Wide Awake a few times. I think maybe, but I do know that he was starting to make the rounds. He became really popular, man, with his silver rants. He was really on that silver. He would pull up the handwritten chart and stuff, man. Gosh, man. Okay, gotta move on. Let me move on. Good grief. All right, so yeah, that's all I got on that. So basically, yeah, that article was, and I take issue with some of the things in that article. Um, Again, as time moves on, they're going to keep talking about this. If anything happens with the Comex, you guys, just like I told you from day one, if anything happens with Comex, it's because of fraud. All right, straight up fraud. The way the commodities industry was built is supposed to be insulated from that kind of stuff. That's why I'm seeing negative oil prices and stuff. They're just doing all types of irreparable damage to the good name of the commodities industry. Commodities industry was the most cleanest financial industry on Wall Street. It was one of the only few bright spots where no one's ever been taken or beaten out of their money, and then when MF Global and John Corzine gets up in there, boom. Notice how as soon as he got up in there, you start having problems with fraud. As soon as John Corzine hooked up with MF Global, that's when you start having problems. Before he hooked up with them, they wasn't having problems like that. But after he came up in there, boom. That brings down everything. It's always fraud, man. It's always fraud, and corruption. Corruption brings everything down. And then a lot of people, good people got hurt. So that sucks. All right. I think we're about ready to wrap this up for today. I cannot believe all of that, man. That's just, man, Jim Kaminsky. Goodness, man. All right. We'll save some more for tomorrow. Now, tomorrow we're gonna start getting into some other stuff dealing with the economy as far as these markets, because I told you this week our focus is on economic and markets. Last week we dealt with the specifics of the coronavirus. Now we're going to deal with this other stuff because we got to. We'd be remiss if we didn't. All right. So with that being said, man, you already know what it is. You know what we do. All right. PulseWaveTrading.com. You already know what it is you need to be doing. You need to come get this money. Come break bread with us. Stop playing around and make it happen. Remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And I will see the rest of you guys here this evening for the end of the day report. And everyone else, I will see in the trading room. All right. Peace out.